And yeah, one's called Aruba, one's called Altion. But my passion has always been doing real estate. Right? So I started off by investing in other people's deals. I invested in about 10 apartment deals, and in total about 13 different kind of syndications. Um, so things like self-storage, things like apartment fund portfolio, things like plumbing companies, new build, new construction, student housing, you name it. I basically tried them all because I want to see firsthand how they operate and which ones are actually the good investments. And then after that, after I got pretty experienced, we started acquiring deals of our own, and those are the assets that you have seen. So we're still very actively looking. We focus primarily in the Dallas-Fort Worth area, but we're also looking at Austin. So right now the market is completely crazy. It's very expensive. We're being very cautious. We want to make sure that whatever property we acquire will make money for everybody. Okay. So my partner in crime, Dave Lin, he also owns a lot of rental properties around the country and in China as well. He has a presence in Austin. He has multiple quadplexes there. So he's also pretty experienced in the multifamily experience investing. Okay. So a couple of deals that we had. Encore was a $23 million deal. It was 218 units, and that's in Grapevine, Texas, right next to the Dallas-Fort Worth airport. And also Arbor Terrace, which is 143 units in Arlington. Okay, and that one was close to $12 million. Both of these are doing pretty well. Throughout the whole COVID cycle, these apartments maintain over 92% occupancy ever since, ever since April. So in fact, one of the apartments, Arbor Terrace, right now is actually at 100%. And our collections, we've been collecting 92 to 100% of where we were pre-COVID. So that's one of the reasons why I invest in apartments, is because it's downturn resistant, right? It actually does really well, even when the economy is not good, because people need a place to live. Cool. Yeah, so this is Arbor Terrace, Class C property. It's doing really good right now. It's all snowed in, but yeah, occupancy has been great. Collections have been good. Whatever shortfall that we had in the rentals, we're actually receiving government assistance. The tenants are getting rental assistance, so we've been able to keep up the collection with in fact, last month was probably, we achieved higher collections than even pre-COVID. So it's been good. A quick overview, different classes of apartments: Class A, Class B, and Class C. Class A is not doing well right now. People don't, in this economy, people don't have the money to live in expensive apartments. So they all move down to Class B, right? Class B people move down to Class C. So in downturns, Class B and Class C tend to be very full, while Class A in like San Francisco, it's probably sitting at 60% occupancy, and they're having to offer 2 to 3 months of free rent, just to attract the people. Okay, so what we do is, on these properties, we go in and we convert the classic units into a very nice renovated unit, right? And I'm sure a lot of people saw this, but when we buy things at apartment scale, we buy 200, 300 of these appliances, they become very cheap. So I can renovate this entire 800 square feet apartment for about $3,000, including the flooring, including the appliance. So it becomes very efficient to invest in that. Okay, so this brings us to our today's topic. I love having Brian and other guest speakers because then I don't have to talk so much. but really, you know, I work with Brian a long time. So, you know, as many of us in the tech industry, we have our current income, but you know, through switching companies, we also have a pretty sizable retirement fund sitting there, not really making much money other than, you know, your regular 7 to 8% S&P 500 over the years, right? So Brian, Mr. Brian actually helped me set up a self-directed IRA account. There's two things that you can do. You can either do a self-directed IRA or you can do what's called a solo 401k. Mr. Brian will go into more detail about that. But what it is doing is you can convert your IRA account. You know, this could be a rollover IRA, this could be, you know, your traditional IRA, and you can invest, you can open up and invest in more than just stocks, mutual funds, etc. Right? You can now actually buy land, you can buy real estate, you can use that money to invest in real estate syndications, right? That, you know, they could be buying commercial property, it could be office, it could be apartments, you know. One thing that the people locally in Silicon Valley also like to do is they can actually invest in pre-IPO startups. Okay. And you know, it just opens you up to, you know, so many more investment options. And the best one is, you know, in my opinion, real estate syndications. You know, you can invest while still preserving your cash and get a higher return. So one thing to know, a lot of people ask me this, you can't really invest using your current company's 401k money. You need, you know, what's available for you to invest is, you know, funds that's already rolled out of your 401k. So your rollover IRA, your traditional IRA are money that you can invest with. Okay, so I personally, you know, have set up a self-directed, you know, 401k account. Mr. Brian Eastman helped me do that. A lot of people in this meetup has also had Mr. Brian help us with that setup. And many people have invested in syndications now. They can leverage the use of their retirement funds. So once it's set up, so for example, I hold my IRA account in Schwab. So you can buy stocks, you can buy anything just like before. And then when there's an investment available, you know, there is a checkbook you can use to write checks to do these investments, or you can just directly wire from Schwab to the investment account. So once the setup is super simple, okay, you know, it's just like it almost feels like a normal bank account. Okay. There's some pitfalls to watch out for. Mr. Eastman will go through that. It does, so basically what you're doing is you're taking your traditional IRA account and then you're able to create or convert your IRA account into what's called a self-directed IRA account. And then you can choose however much money you want to move on your IRA account into this self-directed version and invest. Okay. It takes a little time to set it up. It takes about 2 to 3 weeks. So you want to set this up early. Okay, so talk to Mr. Brian, have him, you know, look over, you know, come up with a plan and set this up early, because if you wait until a deal is announced and then go set it up, you may not, you know, this setup may not be in time for you to join the investment, because usually from the time that a deal is announced, it's about 2 weeks for that the funds have to be wired, right? So if you wait until that time to set it up, it may be too late. So I highly encourage everybody to try set it up now. Once you set it up, you know, it's there. You can move all your money there and buy stocks and just hold your normal holdings there. But you know, you just don't want to worry. Okay. So with that, I'll turn it over to Mr. Brian. I think we're very lucky to have Mr. Brian Eastman join us. He's been doing this a long time, and he's helped many people leverage their retirement funds for investments.
Hey, Tony, sorry to interrupt. Just real quick, I think there's a hot mic. Somebody's mic is not muted. If you can't mute that person, that would be great. Thanks.
Okay. Is that better? I think.
Yeah, I think it was Dave.
Was it Dave? Okay.
He was printing in the background, but yeah, it's muted now. I saw the one that was making noise. I think we got it fixed, so I think we're good.
Cool.
Okay, thank you.
Okay, thanks. So, Brian, I'll stop sharing.
And then I go and share my screen and go there. Let's see. There we go. All right, are you guys seeing the slideshow there?
Yep, we can see it.
Okay, perfect. Well, Tony, thanks a lot for having me again. I know we've done a couple of these. I think you and I worked together, 4 or 5 years ago now when we set up your plan. Like you said, a lot of the investors you work with have seen the benefits of being able to hold more different types of assets in their retirement plan, and been happy to help people explore that, and look forward to giving folks just a brief overview tonight of what's possible, and we'll have some time for some question and answer. But for the most part, we do a couple of different plans. Everything's pretty personal, so a one-on-one consultation in the future is going to be the best way to go forward. But yeah, what we're going to talk about is the ability to take existing tax-sheltered retirement funds and invest more broadly than just the stock market with it. Really pretty simple to do. Let's see here. How do I? There we go. So again, as Tony introduced me, my name is Brian Eastman. I'm one of the principals with a company called Safeguard Advisors. Since 2005, we've been specializing in offering what are called self-directed retirement plans. One of the leaders in the field. What we do is a real super specialized thing. There's only a couple of firms that do what we do, and we've established ourselves as real leaders in the space over the many years we've done this and worked with thousands and thousands of clients all across the country. And we really take a focus not just on providing the plan platform, which is important, it's a little different, but really helping our clients understand what it is, why it is, how they can go successfully use these tools to invest. There's some IRS rules you got to navigate, things like that. And it's pretty simple if you got a good team around you, but it wouldn't be something you'd want to go try and figure out on your own. So something we really take pride in helping people work with. I'm personally just a consultant, somebody who's been doing this for a very long time, but on our team we have the people who really know what they're doing in tax law and real estate. I do a lot of real estate myself as well, but just all the backing around this area to help our clients go out and succeed. So when we start off, what is a self-directed IRA? It's really pretty simple. It's the same IRA we're all used to at Schwab, Fidelity, Vanguard, whatever. It's got the same tax-sheltered status. It's got the same, timelines and contribution amounts and beneficiaries and whatnot. It's just got more investment choices. All the big name firms that we're used to focus on one thing, which is the public equities markets and stocks and funds and things like that. Well, the tax law has always, going back to the 1970s when these retirements were created, allowed for much broader choices, things like real estate and stock of privately held companies, and pretty much anything other than collectibles is allowable. But the thing that most people invest with a self-directed IRA is things that are real estate related, maybe some private equity, but it's an asset class that makes a great diversification play and is really well suited to real estate, because real estate is a solid asset that produces consistent returns. And what better thing to put in your retirement plan than something like that? But we help people just invest more broadly with their retirement plan. one of the first things, as Tony sort of touched on, if you're interested in this, is you got to make sure that it's something you can take advantage of. And the first piece of that is you don't start from zero. You're not going to invest in real estate with, the $6,000 that you can put in an IRA in a year. But you have to have some funds that you've accumulated over time, maybe working at an employer with a 401k or something like that. But the funds have to be accessible for transfer. If you currently work for Google and have money in the Google 401k plan, we can't move that. If you used to work for Apple before you went to Google, your old Apple 401k is something that we can move. You're no longer employed there and you can move that plan. The exception would be if you're still with a company after the age of 59 and a half and participating in that plan. Once you've reached actual retirement age, you can still be working there and participating, but move at least most of your plan, if not all. But it's really previous plans, or if you've separately had an IRA or already rolled the 401k into an IRA, pretty much any IRA can be moved. And then, like I said, you need to have enough gas in the tank to be able to accomplish the goal. You're not going to invest in real estate with $10,000 or $15,000. Costs money and takes time and energy to set up and manage these plans. It's a little more intensive than a brokerage account. So you want to have enough money to generate enough return to justify the effort. It doesn't take a lot, but it's again not going to be that $10,000, $15,000, $20,000 level. And you can extend your purchasing power. You can use mortgages, but there are limitations on what you can't do. You can't mix IRA funds and personal funds, for example. Sometimes you can share, partner between, like, say, your funds and your spouse's funds, but it can get a little tricky to do. So a real good starting point is having some decent money. I'd say, minimum around $50,000, maybe, $100,000 starts giving you a lot of different opportunities, but that's where these vehicles really start making sense for an investor. As I mentioned, we're still keeping the same tax sheltered retirement plan format here. We're not changing that at all. So when we take this tax sheltered money and we invest it differently, we have to follow some rules that are set by the IRS to keep this money tax sheltered. I like to say this is piggy bank money, or this is your future self's money. It's not your today money, is the way to think about it. And when we look at the IRS rules, they can get a little bit complex in some areas, but when you simplify them, it boils down to a pretty basic concept, which is that everything has to be done exclusively for the purpose of benefiting the plan, not for your own personal benefit today. Your benefit is, I'm growing my retirement savings. I'm going to have more money when I'm older and not wanting to work anymore. And what that means is that everything has to be done at arm's length, and you have to avoid any kind of self-dealing or dealing with what are called disqualified persons. And disqualified persons are you as the account holder, your spouse if you're married, lineal family like parents and grandparents and children and grandchildren, the spouse of a descendant like a son or daughter-in-law, or an entity like a business or trust that one of those family members control. So you wouldn't buy from or sell to. You wouldn't go, buy a second home up at Lake Tahoe that you want to rent from your IRA, or you wouldn't buy a property at the college town where your kid's going to go to college and have them rent from your IRA or things like that. Everything is just the same way you think about your investments today. How can I place this money in a way that's going to grow the IRA, but you're not really looking at personal use or personal benefit? The plans that we offer at Safeguard Advisors, like I said, what we do is really unique. We focus on what's called checkbook control. And for most real estate investors and people who are really looking at alternative assets, it's by far the most flexible and efficient way to do this kind of investing and the best supported. And when we talk about checkbook control, we really mean putting you very much hands-on, able to manage the investments yourself. So I'll talk a little bit about our structures later, but the end result is that under the umbrella of your retirement plan, you'll have funds in a bank or brokerage of your choosing. And you'll have signing authority on that account so that when an opportunity comes along to invest, you can sign the contracts, you can fund the expenses of acquisition or maintenance, you can receive the income produced all directly. And that eliminates a lot of third-party processing and delays that can happen in the other kind of self-directed environment, which is where you're really hiring a third-party processor, what's called a custodian. And just that model is like putting the Department of Motor Vehicles between you and your investment. Just everything has delays and fees, and it just gets really clunky. So this checkbook control that we provide works really nicely for real estate investors and investors looking at a different, more diversified portfolio. There's two different plan types, as Tony indicated, that allow us to provide checkbook control. Anytime we start with a new client, the first thing we do, maybe the second thing, the first thing we do is kind of ask what they're interested in so we know what we're talking about. But really, when it gets down to business, the first thing we do is find out what the best plan fit for that particular person is. And some of it's determined by what kind of money, what kind of their employment status, what some of their investment goals. There's no one size fits all solution, but we have these two opportunities. When we talk about a checkbook IRA, that's an individual retirement arrangement. Pretty much anybody can set that up. And it's going to be based on an IRA type plan. It's going to have the ability to invest in anything the IRS rules allow for. That applies to both plans. You'd be able to fund it from a lot of different types of plans, whether it's a rollover from an old 401k or a Roth IRA or even an inherited IRA that you might have. A lot of different ways that you can get money into an IRA. And it's a nice tool for taking money that you've already accumulated and being able to invest differently with it. The solo 401k, that's our other plan option, is all of that same stuff. You can invest in anything, you can fund it from a variety of different sources, has the checkbook control, but it brings the power of being a bigger, better retirement plan in and of itself. So you can add more money. There's a few other features that it has because it's really based on an employer 401k format as opposed to an individual format. The thing with the solo 401k is not everybody can have that plan. You have to have a business that's setting up that plan as an employee benefit, and it has to be an owner-only business. So we work with a lot of people who are, independent consultants receiving 1099 income. We have people who are real estate agents who have that kind of self-employment, or maybe they own their own consulting company or something like that. But they've got their own business that doesn't have any employees. Because if you have employees, you can't be in the solo 401k. You have to be in a big company 401k that's going to provide coverage to those employees, and that doesn't work well with self-direction. But for those people who are self-employed, have an owner-only business, the 401k has some nice features. It's a more direct route to controlling the funds. I'll talk a little bit about how that works. It's got much higher contribution limits. You can put as much as $58,000 a year tax sheltered into a 401k style retirement plan if you make enough income in your business. You can have both tax deferred and Roth features in the plan. There's an ability with a 401k style plan to borrow a little bit from your plan if you had an emergency or maybe some personal business deal that you were doing that needed just a little bit extra money. You didn't want to borrow from a bank, you'd rather borrow from yourself. And the one difference on the investment side between the solo 401k and the IRA is that if you're using mortgages or debt financing, it's a little simpler and cleaner in the 401k, and I'll talk about that later. But they're both great plans. If you get out and you research this on the internet, everybody wants to talk about how great the 401k is, and it is. The IRA is also awesome, and for some people, it's all that's available, or it's actually even better, even if they do qualify for a 401k. So I always want to take a good look at what's going to best suit your needs. Talking about the checkbook IRA in just a little bit more detail to help you get your mind around it. It's a two-layered structure that gives that checkbook control that we talk about. We start with an IRA account held by a specialty institution. We use this company out of Kentucky called Kingdom Trust to act as the IRA custodian, and I would describe them as being like a Schwab or an E-Trade or a Vanguard with different paperwork. It's people pushing paper instead of computers doing stock trades. But everything about the regulatory environment and FDIC insurance and how the IRA works, contributions and distributions of beneficiaries, that's all the same. So that's what makes this an IRA. That's what keeps the IRS happy of knowing somebody's reporting on this money. In theory, you could stop with just that account at Kingdom and ask them to make a non-traditional investment, but then they're holding the checkbook. So they're signing the documents, which takes them 4 or 5 days. They're funding, they're receiving the income. They charge you money every time they make a move. It gets real clunky, as I said. So what we do to create checkbook control is we take that IRA at Kingdom and we push it to the back, and we have it make a single investment into a specialized trust entity that we create here at Safeguard. And with this trust, we're essentially creating our own private fund, is the best way to think about that. So the IRA is going to own the trust. You as the IRA account holder can be the trustee and have control over how that trust operates. And that's what gives you what we call checkbook control, because now you have signing authority, you can execute a contract, you can use the trust held bank account that you have to fund a transaction and deposit the income into. We've taken the custodian that we have to have and pushed them into the back seat, and you get to sit in the driver's seat and control the investment. So just much more efficient. And then for any of those of you who have researched this field a little bit, you may have seen where the same concept is provided with an LLC instead of a trust. And if you lived in Arizona or Texas, that'd be just fine. We don't like LLCs in California. They cost $800 a year. There's a complicated tax return that you have to file with the state of California, even if you're investing outside of California, or even if you form your LLC outside of California. If you reside in California, you're subject to all that. I love California. I grew up there, went to school there. Tony was joking earlier that it's easy to get me out there because I don't have to fly out. I love flying out to see Tony because I get to go visit my parents, right? But California is a difficult place to do business. So it's nice to eliminate that difficulty by using this trust structure that we developed several years ago. But that's the idea, is this IRA-owned trust that you can use. As Tony said, he was a little optimistic. He said it's about 2 to 3 weeks to get set up and funded. It's usually more like 3 to 4, and right now, maybe even 4 to 5. The whole financial services industry is just completely overloaded, and they're understaffed due to COVID, and things are taking just a little longer than normal. So Tony's advice to, if you're interested in doing this, getting started a little early was very good advice, and I'll talk a little bit more about that later. But it's a really nice program that gives you that control. Big picture, there's fees that we charge and there's fees related to the IRA account and whatnot. But when you add it all up, nothing else involved, it's $1,550 for the whole setup in the first year. And that's reflecting a $150 discount that's passed through being a member of this group and coming through Tony's recommendation. And then in future years, it's just $125 per year in some administrative and reporting costs that are handled through Kingdom as the custodian. They have to report to the IRS and hold your account and things like that. So very low cost to set this up and maintain this, because that's all you're spending over for however many years you use it. It doesn't change based on how many dollars you have or how many investments you're making or things like that. The other program we have is the Checkbook Solo 401k. And as I mentioned, it's designed for somebody who has an owner-only business, and you can be a sole proprietor, or you could be an LLC or an S corp. It doesn't matter, but it's just that owner-only format that I discussed earlier. One of the nice things about the Solo 401k is that we don't have to get creative to get you control. In an IRA, we have to have a third-party custodian by law. That's not the case in the 401k. And in fact, what a 401k is, as dictated by the retirement laws that it's formed under, is a trust. It's a form of trust in and of itself. So the plan is a trust, and as the self-employed business owner who's setting up the plan, you get to be the trustee. So we don't have to have the IRA plan with a separate custodian and then have the IRA invest in a trust. The plan itself is a trust. So it's a little more direct route to your ability to control funds, reduces a little bit of the cost layer, just a little bit. Not a big deal in the IRA that you have to have that, but it's nice in the 401k not to. As I mentioned, there's very high contribution limits in the 401k. I mentioned $58,000. That would be for somebody under age 50. If you're age 50 or older, you can actually put a little bit more money in and bump that up to $63,000. You'd have to make close to $200,000 in your business to be able to do that, but you can get a lot of money into a 401k and build your savings on the front end and potentially reduce your tax burden from the income you're producing. I'm not going to spend a lot of time on it today because it's not really the focus of what we do, but 401ks have both tax-deferred accounts where you can put money in and reduce your taxable income. They also can hold Roth money where you can build that nice tax-free wealth building tool inside the 401k. So really nice. And as I mentioned, there's an exemption on a certain tax I'll talk about later that a 401k has that an IRA doesn't. And again, big picture, total fees, everything you're looking at, it's $1,225, including that discount that's available through this meeting, and the same $125 a year. It's a little different than what goes into that, but those are the costs you would have with this program. And again, that doesn't change whether you're working with $100,000 or $1 million, whether you're doing one investment or 10 investments. Those are structural costs for building and supporting the plan that you're going to use.
So
I mentioned.
One thing I'll add really quick is so I set up this account with Brian about 4 or 5 years ago, and
yeah, I think it was in 2017.
I think so, yeah. So and since then I've made 5 investments using my retirement funds. So I'll go over some examples of what I invested in and how they're doing. And I think I was really happy with it because I was able to get a much higher return by retiring and by using my retirement funds, and I didn't have to dip into my cash, right? So and that's just great. Sure. Brian, we have a couple of questions on chat. Maybe you can help answer that.
Yeah, this is a good break. I have just one or two little more things I'm going to cover, but we can take a little break and answer a question or two. Where do I get the chat window?
The chat window is on the bottom. If you still have the menu open.
Yeah, maybe. Oh, you know what? Maybe I need to do. Maybe I need to.
It's okay, Brian.
Minimize. Yeah, that's okay.
I think what I'll do is I can just add.
Oh, there we go. I got the chat open. Okay.
Perfect.
So somebody asked what would be the. I'll go backwards. What would be the minimum range? And I'm assuming they're talking about how much to bring in and invest. And we don't have a hard minimum requirement, although we really discourage people with less than about $25,000 or $30,000, unless they happen to be investing in something that doesn't require a lot of money and can generate good returns. We're seeing a lot more people with small accounts looking at cryptocurrencies, for example. And the rate of return can be high. It's a speculative thing that you wouldn't want to put a ton of money in anyway. So it just depends on what you're doing. For real estate investors, I really think sort of the $75,000 to $100,000 range is where this starts making sense. You can do with less, especially if you're in the 401k and you can continue to add money in future years. I mean, that really changes. I've got people who start out with next to nothing, but they know they're going to add $30,000 or $40,000 a year. So why not? So it depends on the person. And then Asif asked if an entire Roth IRA has to move or be partial, and that would the answer would apply to most any retirement plan that you have. You do not have to move a whole retirement plan usually ever. The one exception would be if you have an old 401k with a former employer and you go to move some of that plan, they might want you to move all of it. But you wouldn't have to move all of it into here. You could move part of it into your self-directed vehicle and part of it into an IRA at E-Trade or Schwab. But usually, if you have a Roth IRA, for example, and it was worth $300,000, and you wanted to keep $200,000 in the stock market and take $100,000 to go invest in a real estate syndication, you can do that. And in the future, if you say, you know what, that real estate syndication is doing great, I want to do another one, you could take another $100,000 from that other Roth IRA and move it later. Costs you a wire fee, but it doesn't change the tax status of the money, and the plan can accept that. And then going down a little bit, somebody asked 401k or 401k trust. They're really one and the same. A 401k plan is a form of trust. Good. Well, let's move on, and let me just wrap up a couple of the main presentation things, and then we can turn to some more questions. One of the things that comes up in a lot of different investments is the use of debt financing, things like mortgage financing that come into play in real estate. And these self-directed retirement plans really allow you to take advantage of this powerful investing tool. In theory, you can use leverage such as margin trading in the stock market in a retirement plan. Not a lot of accounts support that, and it's just too risky. It's too volatile. You don't have enough control over the things, and the idea that you could lose a lot of money in your retirement plan could be really detrimental. But in real estate, you have a lot more control, and bringing leverage in can be really smart. But it's a little specialized inside the retirement plan. And this is part of the type of thing that we help clients with if they're working with us, is understanding these things. But there's two special things to understand. Firstly is that any debt instrument needs to be non-recourse, meaning no personal guarantee from the IRA account holder or one of those disqualified persons we were talking about associated with their loan. So if you were going to go out and buy a little fourplex or twoplex with your IRA, and instead of paying all cash, want to use a mortgage, it would need to be a non-recourse mortgage. Basically, that property would be qualifying for the loan, not you. You can't pledge a guarantee. And there's a handful of lenders we can introduce you to that do those types of loans. And then in an IRA, there's a small amount of taxation, and the key word there is small. And I'm not going to spend a lot of time tonight on how that tax works, but the basic idea is that your IRA is, in addition to receiving return based on its amount of capital, is also receiving return based on the non-IRA money, the borrowed capital that's in the deal. And so that portion of the income that's coming from the non-IRA money is subject to tax. But once we introduce taxation, we then get to take advantage of deductions like depreciation and deductions for the interest on the note and things like that. So the amount of taxable income usually gets reduced to a pretty small number. And then that pretty small number creates a tax liability for the IRA, and because it's a relatively small number, the amount ends up being pretty small. And it's, so a fraction of your income on a leveraged real estate transaction ends up being taxable, and usually at a relatively low rate. So you might add a couple $100 in taxation in a year on, say, $100,000 leveraged syndication investment. So you're going to make $10,000, you're going to pay $200, $300 in taxes. You're still going to get a great return that's leveraged. That's a better return than if that apartment complex had been paid for all cash. So something to know about, something to know that you have the responsibility to deal with the tax filings and things like that, but certainly not something to be afraid of or intimidated by. It's a very, very powerful strategy and a way to accelerate the growth of your IRA. I think I have a little example for us. Yeah, and this is one sort of based on a syndication to just give you an idea of the numbers. So say you're putting $100,000 as a limited partner into one of those deals like Tony talked about, $4 million down on an $11 million project or whatever the case may be that investors are putting together. So say the investor money that's being brought together through the syndicator is 25%, and they're borrowing 75% from a bank. So that deal is 75% debt financed. They're planning on fixing the units up and holding onto it for 10 years and then selling it. Say you're going to have an average of about 10% return on rents, which Tony's going to look at me and laugh and go, that's low. We do much better than that. But I like to put conservative numbers up here. And again, in that case, with your $100,000 investment and that 10% return that you're getting, that's 75% debt financed, you have just less than $300 in tax at the end of the year. So that basically put just over 0.5% dent in your return. So if Tony comes out and says, we're getting a 15% return on this project, you're seeing a 14.5% return. And that's really good. That's really good. So it's again, it's not a big deal, but it is something to know of and understand if you're going to work in this space. And that was it. I wanted to keep it kind of simple tonight. If you have an interest in learning more about this, there's a link at the bottom of this page. You can visit on our website and schedule a call. We have been very, very busy lately. This whole financial services sector is really exploding right now. So scheduling a call is the best. We can usually schedule, within half a day or a day out. It's not a big long wait, but just keeping things a little more organized really helps. We'll typically spend about half an hour in a first phone call, figuring out what your goals are, what kind of money you have, what plan's going to fit best, and getting in more detail than I gave tonight. But you can visit that link and learn a little bit more about us. And again, if you came in through this meetup tonight, there's a $150 discount off of our plans that's available to you. So that's how you can learn more if you want. I know I'll be giving Tony the slideshow on that website page that's linked there, the 123.com/link. We have a download of a white paper we've done on investing in real estate syndications with IRA and 401k money. So feel free to go and grab yourself a copy of that. It's good information. But that's kind of my overview that I wanted to present, and I'll turn it back over to more questions. There we go. Okay, so I got our list of questions open. A little tricky here. So Paul looks like asked. He's a residential developer.
I don't think that's a question. Brian, I think you can skip that one. That one's not a question.
Oh yeah. Okay. Yeah, you're right. Okay. Yeah, I was reading down lower. Okay. And then somebody asked, how is the rental income reported to the investors, and what tax forms do we need to file? Depend a little bit on the type of investment you're doing, but if we're asking about a syndication like what Tony and his group are putting together, in those types of an investment, your IRA or 401k would be a limited partner in a larger partnership that's going to own that project. And the lead partner and their accounting team are going to issue to the investor partners what's called a K-1 for the income that's produced. And that would be true whether you're using IRA money or personal money. You're going to get your share of the income reported on a K-1. As a retirement investor, that's not going to be taxable income in and of itself. It's like you got dividends off of shares of a publicly traded stock. And if you're in a 401k, as I mentioned, even if there's debt financing, there's no taxable income there. So you would take that K-1 and you would keep it with your plan records, and you would be done. You wouldn't be filing a tax return. In an IRA, a portion of the income that's on that K-1 is going to reflect the debt financing piece, and then you would work with your CPA to file a tax form for the IRA, completely separate from your own tax return. That's called the 990T. It's a trust tax return that the IRA files, and it's short. It's a little one-pager with a separate one-page schedule, but it reflects how much of the income was debt financed, what deductions were available, and some pretty, I would say, simple calculations for a CPA. It's not a return anybody would do themselves. It's not available on, TurboTax or stuff like that, but pretty simple to hand that K-1 to your CPA and have them maybe spend an hour doing the return and coming up. So it's not a real big deal.
Yeah, it's actually pretty straightforward. So like what Brian mentioned, at end of the year, we give each partner a K-1. So on the K-1, it's a partnership income report. So on the K-1, it'll list out like how much money did the syndication make this year? What is the property value, etc. Right? But with depreciation, most likely the first few years, even though you're getting like, I don't know, thousands of dollars in cash flow distribution, you actually won't see a reportable income for the first few years. So I think for one of the property, even if you distribute $4,000, $6,000 a year, the K-1 actually shows that due to accelerated depreciation, it's actually negative $70,000, right? So with apartments have this feature, accelerate depreciation, right? So instead of it's a way that you can take advantage of tax deduction. So
sure. Yeah, and I'd add to that two things. One is the white paper that I mentioned that's on that website at the bottom of the page does illustrate what Tony's talking about. I think our sample, I forget if it looks at a 7-year hold or a 10-year hold or what, but the first 2 or 3 years have either zero taxation or a small amount of negative. Usually the amount's small enough it's not worth filing a return to carry it forward and reduce it in future years. but it's small. What Tony was talking about with accelerated depreciation would apply to somebody investing in a syndication with after-tax money, doesn't apply in an IRA. In an IRA, you have to use straight-line depreciation. But the benefits of depreciation, the offsets of cost of rehabilitating the units that usually happen in the first year or two will typically negate most of the taxable income in the first phase of one of these multifamily projects. And then your taxable income will ratchet up a little bit in, say, years 3 through 7 or 3 through 10, but it's still very, very small and not a big deal. We have another question from Kevin, and Kevin's going to illustrate for us something that you absolutely cannot do with an IRA. He asked if it's possible to use IRA money to pay off the mortgage on his rental property. And the answer is no. Kevin is a disqualified person to his IRA, so his IRA can't transact with him in any way, direct or indirect. So that's just simply not possible. When you're looking at investing with the IRA, you have to go find a new investment that's being done exclusively for the IRA.
Yeah, so another way to kind of explain this is the IRS wants to prevent people from funneling their retirement money into their normal life, right? So one of the things that Brian mentioned is like, okay, you cannot take the self-directed IRA money, buy a house, and then go live in there, right? In a way, you're kind of getting the money out. Or you cannot buy a home, work on it, and then pay yourself using that retirement fund, right? Because then you're kind of funneling the retirement fund out into your own person, right? So that's typically when Brian says that it has to be you're disqualified, right? You cannot actively benefit from this investment. So meaning like you as a person cannot benefit. The retirement fund cannot pay you. But if you're passively investing in another deal where there's a other property management company that is getting paid for managing it, that's okay, right? They're getting paid, not you. So that's why it is so useful to invest passively in syndication this way.
Yeah. Passive syndications are, I mean, they're great. They fit all the rules. They're again a solid asset that produces consistent leverage returns. They're one of the best things out there, frankly. We have a question from Ashok, who asked if he and this actually, Michelle has asked sort of the same question, which is basically, what do you do with money in between deals, or if you don't have a deal at the moment? And as I mentioned, when we're setting up these vehicles, we start by moving the money through Kingdom. We don't leave money at Kingdom. We then turn around and invest the IRA money into the trust that we've created, or put it in the 401k. Well, inside that checkbook plan, whether it's an IRA or 401k, you can hold a brokerage account. The institution is not going to see it as a retirement plan. They're going to see it as a trust style account. But on the back end, the IRS knows it's a retirement plan. So we help our clients establish the right kind of an account with somebody like, say, TD Ameritrade. Not all the brokerages like these custom plans, but TD Ameritrade's a good choice that does. So you can invest in conventional stock market stuff. You can invest in things like real estate syndications or private loans or cryptocurrencies, but you have the choice of all those things. Now, what I would say is if you've got a $500,000 IRA, and you're thinking I'm going to invest about $100,000 in a real estate syndication, only move the $100,000. Don't sell out of a bunch of stocks in your Fidelity account, move the whole $500,000, and then buy a $500,000 back into the market. That's just inefficient and a bunch of wasted time. But you might set up the new plan, move maybe just a little bit more than the $100,000. You'd want to, have a few extra dollars in the bank account or something, but maybe $101,000 or something like that. But move just what you're going to invest. Get it in place so that when the right opportunity comes along, you're ready. And maybe call Tony and say, hey, Tony, I just moved money and set up a solo 401k. Do we have a deal coming in the next 45 to 60 days? If he says yes, you probably sit tight. Don't worry about it. But if Tony says, we're looking at things, the prices are a little high, we're waiting to see what changes, it might be 2, 3, 4 months, sure, go ahead and invest that money in anything else. It only takes a day or two to sell out of stocks and be able to move that money into another opportunity. So you can definitely invest in anything with these platforms.
Right. And then, for me personally, what I did was I actually just went ahead and moved my entire rollover IRA account into into my solo 401k account. Right. So
Sure.
I moved a few $100,000 in there. So, and then while I'm waiting for a deal, I kept the money in the stock index funds and Tesla. so so it's the same brokerage account, right? It's also Schwab, it's also whatever, right? So once you move the money over, you can move the whole thing over. That's what I did. And then, just leave your money in stocks and funds, right? And then when
Sure.
you want to invest in a syndication, sell enough to cover that amount and then just invest away.
Yeah, and it's a little easier in the 401k to move a whole portfolio, and in fact, you can even move it without selling the stocks that it's in. In the IRA, you got to move the cash first to move it, and then buy back in. So what Tony talked about of moving the whole thing works for some people, doesn't work for others. But that's the kind of detail that, as we're talking to an individual, will help them figure out and do what makes the most sense. Have a question here from Michelle. And this is the kind of thing that we'll talk about in an individual consultation, but I'll just cover this briefly for the group to help people sort of understand. And Michelle says she has a traditional IRA, a Roth IRA, and a solo 401k. And I don't know if that's self-directed or if it's just a solo 401k like with a stock market account, which those exist and they're great too. And she asked if she would need 3 accounts, and the answer is no. In her particular case, she would only need 2. The solo 401k could be changed to self-directed if it's not. The traditional IRA could be added to the solo 401k, but unfortunately the Roth IRA can't get added to the solo 401k. There's a lot of powerful features with Roth money that a 401k has, but unfortunately the one thing we can't do is take an existing Roth IRA and move it in from the outside. So you'd look at that Roth IRA and say, okay, by itself, is it worth self-directing that, or do I just leave that in the stock market? But maybe the traditional IRA and the 401k would make sense to self-direct. Again, we'd have that kind of conversation when we speak with somebody to see what's going to make sense. And then when Tao asks, which brokerage firms allow such accounts? In the IRA, we've really pretty much settled on TD Ameritrade and Schwab. And with Schwab, you have to have a pretty big relationship with them. They only do LLC and trust style accounts if you have an overall $250,000 relationship with them. They don't care if an IRA is involved or not. They just don't do those more complex style accounts for small accounts. So TD Ameritrade has been sort of the go-to option for the IRA-based structures. 4 or 5 years ago, we used to be able to say, yeah, go to E-Trade and go to Fidelity and go to Vanguard. But you may or may not be familiar, there were these consumer protection rules about fiduciary requirements that were going to be placed on the brokerage firms. And several of those big players looked at that and said, oh gosh, we could indirectly be considered a fiduciary on this IRA that we don't actually control. So they shut down doing new accounts, which was unfortunate. So TD Ameritrade's been the option with the IRA. In the 401k, almost anybody. All the brokerage houses understand this idea of what's basically, I would say, a custom 401k plan. So instead of going to Fidelity and saying, hey, please set up a 401k for me that can only invest in the stock market, investors and business owners for years and years and years have said, I'm going to set up my own custom 401k with a professional, but I do want to be able to trade some stocks in that plan. So, hey, Fidelity, will you open an account for me? Or Vanguard or Schwab or TD Ameritrade or E-Trade. So almost anybody will hold the 401k style brokerage account. Then Wintao had another question. Besides TD Ameritrade, no, they're really in the IRA. There's not much. There's a couple. I think UBS, but they're the lesser known. We know for sure that Fidelity, Vanguard, and E-Trade won't do the IRA-based programs. Well, it seems like that was all the questions we had. I don't know if anybody had any other questions or if there were some things that you wanted to wrap up with, Tony.
Yeah, I think, it's open mic. If anybody wants to ask any questions, please go ahead and feel free. Otherwise, I'll go and give some examples of what I have done. Okay. No? Okay. So let me go back to presenting my slides then. Okay, so let me just kind of show you guys. Like I said, I actually invested in many different kind of projects. So the nice thing is, it's tax deferred. Who wouldn't want that? So, I did what Brian described as a solo 401k, right? One thing about solo 401k, it's more flexible, but you kind of need to have like income for the solo 401k that you're doing. So if you have your own business, you have some small side income, I think that would be great, but not many people do, right? So, but self-directed IRA, is what majority of the people go for, and it works great, right? I think Dave has one. I mean, many people has a self-directed IRA. So here's one thing that I invested in. I'm just gonna show you guys about these. It's kind of interesting because this deal is actually selling this year. It's actually pretty good. So this was one of the first things I invested in. The project is called Asher. It was a 300 unit apartment. So what this group does is they buy some really rundown property, and then they do a full renovation on it, right? I mean, we're not doing like the $3,000 light renovation that I do. They do $15,000 a door, right? So they're tearing down walls, they're completely refinishing the whole property, making it look really nice and high end, all that kind of stuff. Almost like half a tear down, right? So it's pretty scary, So this was pretty scary. That's why I wanted to try it out with my IRA fund instead of my cash. Uh, so yeah, so this one actually, the occupancy went from like 92% all the way down to like 60% occupancy during the renovation phase, right? So residents know that rent is going to go up, and there's a lot of construction going around, so they all left. So the occupancy dropped much lower than we expected, and this investment actually ran out of money. So one thing I've been preaching to people is always, when you pick who to invest with, it's better to invest with somebody who already has money, okay? Because they care about their reputation. And in this case, in order to save their reputation, they took their own money. They let the project borrow $800,000 of their own money. So they injected $800,000 into the project. It finished, it looks great, and right now they're selling. So I think for this project, even though it almost died, if it sells at what we think is the asking price, it's about 150% return. 150% profit over 3 years, right? So would I ever invest in one of these deals again? I don't know. I don't think so. It's like, it's either you lose your entire money or you make 150 grand, right? So $150,000, right? So, but retirement fund, has a little bit more wiggle room there. You can eventually rebuild your asset there. So I can take more risk with my retirement funds. Okay. So yeah, this type of deal, I would call it almost like a construction, right? You're not going to see cash flow for the first 2 years while they're doing all these renovation. The big payoff comes when the property finally sold, but it's very risky. It is very risky, and I'm typically a more conservative investor, so this was an interesting one. Another one that I invested in is actually a self-storage. So this actually used to be an office building. It was a 6-story office building, and they were just storing old paperwork and all that kind of stuff. Okay, so what they do is they take this big empty space on per floor, and they build self-storage units with it. Okay, it's actually very cheap. There's no plumbing you need to worry about. You don't supply electricity. There's literally like no maintenance going on for these things, right? So what they do is they just put down some poles, 4 poles, and then they wrap the sheet metal around the poles, and there you go. You have a storage pod. It costs very, very little money to set this up. This was in Wisconsin. With self-storage, you really want to look at your profile, right? So you want to make sure that it's not too high end, because the class C level people would be more likely to use self-storage. And this place is 100% full. It leases so easily right now, because when the economy is not good, people move out of their homes. They move out of homes, they downsize to an apartment, for example, and then they have all these furniture and all that kind of crap that they don't know what to do with. So when the economy is bad, self-storages are full. So I don't know if you know, I tend to go for deals that will do well in the downturn. So I'm okay with not making as much money, but I don't want to lose my original investment. So with this deal, it's behind schedule. Okay, main thing is because this was actually a historical building, and it took them 1.5 years to figure out the permits, to get the historical building credits, etc. So once again, I thought that if it doesn't have cash flow in the beginning, then my retirement account will be a good use, a good source of fund to invest in these type of in these kind of deals. So, okay. And then, basically with Mr. Brian, basically what he helped me set up the intermediary accounts to transfer my funds from my Vanguard account all the way to Schwab, right? So a lot of you were asking like, okay, so you're waiting for a deal. What do you do with the money? Well, yeah, you can, I log into my Schwab account. There's my normal brokerage. There is my 401k trust account. And then there is my checking account, right? So you're able to do everything that the brokerage can. So it feels completely normal. Okay. And just in case you're curious as to, what Arbor Terrace looks like right now under the snow, you don't expect to see this in Texas. They get to like 120 degrees in the summer, right? And this level of snow is just ridiculous. But the good thing is, as long as you prepare yourself well, residents are happy. They have the heat, they're happy. And they take the snow and then they melt it. So on the second day, you see like a lot of people walking by the pool to get the water for flushing. So I thought that was kind of interesting. Cool. Let's open it for some questions, I think. So Asif was asking, how does one go about finding these projects and investments? So there are a lot of people doing different kind of projects, right? So every office building that you see being purchased, every condo that's going up in the Bay Area, all of these are funded by investment groups like us, right? Some of them are much larger, maybe like 20 people each putting in $1 million. But for us, it is basically a group of maybe 40 to 60 to 80 people. And when we're buying a $10 million apartment, we're putting in about $3 million ourselves. Okay. So, and everybody invests either $50,000, $100,000 or more if they want, right? So usually the minimum investment amount is like 50 grand to 100 grand. Okay. So this way, all the investors pool their money together. And there's always a lead sponsor that goes out and look for these deals, get it under contract, put in the earnest money, and then they're responsible for operating it for the next 4 to 5 years until the property is sold, right? And and these people, we generally call them either active sponsors or we call them syndicators, right? So and that's part of the reason why I have this meetup is because in the beginning, I was also looking for projects to invest in, looking for syndicators to invest with. So the purpose of this meetup is really also for everybody to kind of share the experience. It's like, hey, I'm planning to invest with this person. How has he been? Does he communicate? Is his project good or not? Basically, you get referrals. You can ask people like, oh, who are some good people to invest with? And then I think right now I know like about 40 to 50 syndication groups around the country. And there's probably only 3 that I'm willing to invest with. Everybody else is like, I kind of know how they operate. So feel free to ping me. I can refer you guys to a few. When I pick syndicators, I mainly want to pick people who are conservative, right? Who's not taking unnecessary risks. Okay. What was the next one? Where was the project? Paul was asking where was the project? These projects are in the Dallas-Fort Worth area. Okay, so we have one in Arlington, which is where the Cowboy Stadium is, where the Texas Ranger play. It's the 3rd largest city in the whole Dallas-Fort Worth area. And the other one is in Grapevine, which is right next to the Dallas-Fort Worth Airport. Okay. Any recommendation on the type of commercial investments? I could do a whole meetup about that. But in general, there's a few different types that you can invest in, right? So you can invest in apartments, office buildings, shopping malls, like strip malls, or you can purchase like industrial buildings, right? Each have their pros and cons. As you see, hotels are really hurting right now. They're seasonal, and usually hotels do pretty well, but they're down to like 20-30% occupancy right now. So they're really hurting. Things like retail tend to be very economy sensitive, right? And then industrial has been doing good. Okay, industrial is basically triple net leases to these large companies. They do like 5-year, 10-year leases. So industrial has been doing pretty good. Office, I don't think office is going to do well personally, especially with the remote working trend. A lot of large companies are subleasing their buildings out. My company, for example, basically we actually just broke the lease on every one of our buildings, and we said we're going to work from home 100%, right? So we don't even have an office. We don't need it. And all the large tech companies in the Bay Area, even when the COVID is finished, I'm pretty sure that they're going to allow a significant amount of their employees to work from home, right? So demand for office space, it's not going to be that great. I think this COVID-19 has fundamentally changed people's behavior in terms of working. So Wentao asked, is the goal always to sell the building in a certain number of years? No. The goal is, our general goal is to double everybody's money, right? So if we buy a $10 million building, the investment group ourselves, we put in 3 million, right? So our goal is to increase the value of the apartment by another $3 million. We're not trying to make a $10 million building worth 20 million. No, we're just trying to double our initial investment. So another 3 million. And we do that by renovating, by improving the place and being able to charge higher rent. So, as soon as we're able to do that, we would sell. Or if we think that the current condition is pretty good, we will sell earlier than that, right? So I think the past few years have been really good for returns. I think apartments investments were able to double people's investment in about 3 years' time, or less than 3 years. So a lot of deals have been selling before that, right? If you happen to hit a COVID, then instead of selling in 5 years, maybe you'll sell in 7 years, right? So, but all the limited partners get a vote to decide, when is a good time to sell, right? So, not a number of years, but the number of years is really a rough idea of like how long we think it'll take to double everybody's money. Okay. What kind of vetting do you do to accept somebody into your syndication group? So I'm an investor. I always I always stand from the perspective of being a passive investor, right? So the most important thing I ask people when I talk to them about joining and stuff is make sure that you're not investing with money that you need. Okay, make sure these are your extra investment money, because the worst thing that can happen is we hit a recession, and then you're not able to keep the investment, and you're going to try to see if you can reduce your investment or try to ask some money back, right? But it's very so my advice is make sure that that person has. I typically want to make sure that that person is at least a financial savvy. They know what they're investing in. They know that they're not investing with the last dollar, right? So yeah. Okay. Tony, do you have multifamily deals in the pipeline? Well, definitely looking. So we've actually been looking for the last couple of years, right? I'm extremely picky. I'm extremely picky. If I don't think that I can get the investment group the kind of return that I would want, I wouldn't buy a deal. Okay, so right now, recently, because apartments have been doing so well, prices are very, very high. Okay, so we're being very cautious in the price that we bid up to. And what we're finding in Austin and actually in Dallas as well is when COVID first started, right? So last year when COVID first started, large financial institutions like BlackRock, like JP Morgan, they told their investors, hey, COVID is going to hit. A lot of people, this is going to die. We should get a lot of money and let's buy things on the cheap. So they raised billions of dollars. They have like $5 billion investment funds that they set up. They were ready to pounce on the discounts during summer, right? And then summer came, and then they go, oh my God, apartment occupancy did not drop. Apartments still had pretty steadily at about over 90%. So there were no deals, right? And then what happened was they got all these money from the investors, and they don't have a deal to invest in, right? So they became really desperate, and they started buying up any deal that came on the market, no matter the price, right? They needed to use up the investor money, otherwise it's not making any return just sitting there. So we saw some pretty crazy prices going last year and beginning of this year, and it just wouldn't make sense, right? It just wouldn't make sense. So we're still looking. So we've been looking at Dallas is still our main focus. it's a great place, great employment. And Austin, we're looking at that. Though Austin, when you invest in Austin, you're kind of accepting a lower cash flow, but a higher appreciation, right? It's almost like San Francisco. And we're also starting to venture into places like Salt Lake City, which has been doing really, really well. So hopefully I'll have some news for you guys, soon. But please make sure that you join the email list to be notified. And also, if you want to set up this retirement, if you want to leverage your retirement funds, please set it up early, okay? Because, yeah, like I said, typically, let's say I put a property under contract at beginning of the month. Usually by the third week of a month, we would have done our diligence, we would have finished our business plan, and then we would present it to the investors at week 3, right? And then week 3 to week 5 is when investors wire the money. So if it is going to be 5 weeks for you to set up an IRA account, you're probably not going to make this deal. You probably need to wait for the next one. So generally, so we'll send out, we'll share our email later, and yeah, you can just, I shared my phone number. You can contact me through Meetup or through our email. Anyways, fine. Matthew asked a question. With say $100,000 investment, roughly how much tax deduction can an investor expect annually? So let's take, for example, let's say on a $100,000 deal, right? If you invest $100,000, you get paid in 2 ways. One is every year, because apartments are very profitable businesses. So every year you'll get a share of the cash flow, right? So maybe it's about 6% a year. So every year that the property is held, you'll get about right now it's about 5 to 6% a year. So you'll get $6,000 a year in distributions, okay? And then when we finally sell the property, there will be a large chunk of money coming from the appreciation, right? So finally, all these years of cash flow plus your appreciation is how you get another $100,000, right? So that's where the returns are coming from. So and then so with that question is like, then how much can we expect to so how much deduction are there? So I talked about depreciation, right? So even though on some deals I'm getting like $8,000, $6,000, $8,000 a year in cash flow distribution, but because of the accelerated depreciation, I actually don't show any profit on any of these deals. So all my cash flow taxes are deferred until we sell the property. So I would say for the first 3 years to 4 years, I don't pay any taxes on my cash flow income, even though it's in my bank. So, which is really nice. Apartments are just so tax efficient. So right now, I would say realistically, the deals out there, you're probably looking at 5% cash flow a year. And then when you sell it yearly, you're looking at about, I want to say about 12% return a year is probably what's reasonable right now. Would you open to add investors if you would find possible investment property? Yeah, absolutely. Just feel free to join our mailing list, and that's the best way to be notified, right? So when we actually find a deal, that's when we announce, and it's usually on a first come, first serve basis. The last couple of deals that we had went really fast, like within a day. So we're trying to buy larger properties so that everybody can actually get in. So yeah, joining the email list is the best way. Yeah. When to ask a question, are the rental income distributed monthly or annually. The rental income distributions are, at least for me, is distributed every quarter. So we have 4 distributions in a year. That just makes it easier, you know? So I think you want me to be spending more time on the property rather than writing checks every month. So when to ask, if the money is from IRA, appreciation are not taxable either, right? So I think, you know, so Brian can probably explain this a little better, but for self-directed IRA, yes, your appreciation is not taxable, but you have to pay what's called a UDFI tax on top of that. And that's the small tax that Brian has talked about.
Yeah, that's right. I mean, income from rents or the eventual sale of a property is tax sheltered into the IRA or 401k. If it was an all cash deal, 100% of that would be tax sheltered. If it's leveraged, if you go back to my example, say it was 75% financed and you guys held it for, 5-6 years after rehabbing it. At the end of the cycle, say it's 7 years when you sell, it may not be 70% financed anymore. It may only be 55% financed or something if there's been some pay down on the note. Sometimes you got interest only, structuring, whatever. But whatever that debt financing ratio is at the time the property's sold, that percentage of the capital gain on the sale becomes taxable. And then again, there's calculations that are done that'll reduce the amount of taxable income. So you'll still see some tax on the sale based on the UDFI. And at the sale, when it's a bigger number, it might actually be a little bit bigger number that you're seeing from tax. But you got to remember, it's not a tax it's not money coming out of your pocket. It's reducing the return from the transaction a little bit. And the overall dent, again, is nominal. I mean, if you go look at the white paper, we do illustrate sort of that close of the project and the sale piece, and it just doesn't put that big a dent in the overall return.
Right. So a lot of people get caught up on this. So I'll give a little context, right? So basically, imagine there's an investment, right? So some people are bidding on it using cash, and then here you have a group that is bidding on it using retirement funds, right? That's not really fair, right? The cash people are much more disadvantaged compared to somebody who's using, pre-tax money, right? So in order to keep this fair, what the IRS does is they basically ask the IRA people to pay a little bit more tax to kind of balance it out, okay? And that's the UDFI tax that we talk about if you're doing a self-directed IRA account. But so like what Mr. Brian says, you have to pay a little bit, but in the grand scheme of things, it's still much better than return than what you would have gotten, right? So, for example, on this deal, right? So I invested 100 grand, and then I'm actually getting like 250 grand back, right? And then I'm probably going to end up having to pay $2,000 to $3,000 of UDFI tax, right? So is that amount of money worth 150 grand profit? Yeah. So it's, in the grand scheme of things, it's really not that much.
Yeah, the way I like to explain that is you could do say you're just going to go out and buy a single family house by yourself with your IRA. You could buy it all cash and it might produce 7% return. If you leverage that same exact property, 60% financing, maybe it produces 12% return. And I'm just throwing numbers out here for the sake of an example. This isn't, hard math, but it's going to have a much higher rate of return. Well, okay, so you lose 1% of that and you take that 12 to 11. Last I heard, 11 was still more than 7.
Yeah. You still make more money than, say, if you
leverage wins. Leverage wins every time is really what it boils down to.
Yeah. Yeah, and that concept is really, we can go buy a $10 million apartment, right? All cash. We don't take a loan. but that would literally mean we need to increase the value of apartment to $20 million before we can double it, right? If we take a 70% loan, then we're only putting in $3 million. And then we can double it by just, increasing the value by 3 million. So having leverage, by the way, we take our loans directly from Fannie Mae. It doesn't go through another bank or anything like that. We get our loans directly from Fannie Mae. Right now, the rates are like about 3.1%. Non-recourse, it's basically they can't come after you if the value drops or whatever. So yeah, if you want $50 million in loan at 3.1%, here you go. It's really, really cheap money. So leverage is a great thing. Leverage is what allows us to get such good returns as well. Next question, can the depreciation be used to offset primary income tax? No. So the question is, does your income or loss from passive investments be used to offset your ordinary income that you get from your salary, etc., or your equity investments, capital gains, etc.? No, these are two separate things. It's actually two categories. So passive investments are taxed separately from your ordinary income. So whatever losses that you have there from depreciation stays on the passive side, okay? But if you happen to be, selling, I mean, if one of your investments sold and you have a massive amount of income on the passive side, yeah, you can offset that by investing in another deal that has a lot of depreciation. So that's what people do as well. So this way they can keep their tax low. Asif asks, is it possible to directly invest into the deal without going through a self IRA? You can do that if you're using cash, but you cannot, using your current IRA account, invest in syndication deals. Okay, you have to set up a self-directed IRA in order to expand your investment choices. Okay. Correct me if I'm wrong, Brian.
I get the feeling it was. I get the feeling it was asking, can you invest with non-retirement money? In which case, yes, cash is cash, right? You don't care if it comes from a retirement plan or somebody's savings account.
Yeah. Can 1031 exchange be used in syndications? Generally, you can do it if it is only your own. So 1031 exchange, basically you have to retain the same partners. Okay, so whoever were the participants in the original 1031 must be the same after you have acquired a deal. Okay, if that makes sense. So yeah, Brian?
I see. Yeah, it's really rare in syndications that you see that. And in an IRA, it doesn't matter. That would only apply to somebody who's investing with after-tax dollars.
Right. Yeah. So 1031 exchange is mainly you're basically using cash or the proceeds from your current asset, and then you're 1031 exchanging into another property, right? Yeah. So but usually syndications will not allow you to come in with 1031 as a passive investor, right? Because then the partnership structure is different. So you cannot make that kind of exchange. Okay. Next question. Hey, great questions, by the way. I actually really love answering all these. This is my bread and butter. I just love talking about it. Does each investor obtain the loan separately? No, you actually don't have to worry about anything. So the nice thing about being a passive investor is, other than investing in the deal, there's nothing else you need to do. You don't need to worry about the daily operations. You don't need to worry about any accounting. You don't need to worry about the loan. None of that. So it's perfect for people who are currently working, right? So that's how I was able to invest in 12 separate passive deals while I'm working, because all I do is I invest the money. The active syndicators, they're managing the deal. I don't have to worry about it. I just wait for the checks to come every few months, right? It's just mailbox money. I don't have to do anything. So it is the active sponsors of the deal that have to get the loan. So, if I show you this, right? So on this deal, it was 4 of us. It was Ken, Wind, me, and my partner Helen. It was the 4 of us that is leading, or we're the sponsors of the deal. Okay, so what do? We go out, we find the deal, we negotiate, we talk to the brokers, we qualify for the Fannie Mae loan, and we purchase the deal, right? So we put down about $400,000 to $500,000 of earnest money to guarantee that we will buy this deal. So we do all that. We lead, we handle the entire project. Everybody else is just a passive investor that joins us as partners, and they contribute 50 to 100 grand each, right? So, but it is the active sponsors that has to qualify for the loan. So the loans are actually in our, so we are the responsible party in the loan. The passive members don't take on any loan risk. So to qualify for these loans, you also need to be somewhat high net worth. So for example, if we're getting a $10 million loan, then the net worth of all the sponsors added together must be at least $10 million. Okay, so, but you guys don't have to worry. The passive investor don't have to be part of the loan. So your risk is very, very limited. And we always set up the structure in LLC and other format to make sure that to limit any exposure, to mitigate the risk as much as possible. So basically as passive investors, if somebody falls on the stairs, you're not going to get sued. So you're very well protected. Okay. Does a syndication get the loan as one entity? No. So a syndication consists of the active sponsors and the passive limited partners, right? So it is the active sponsors that goes out and get the loan. Okay. Is the mortgage very difficult to obtain? Yes, it is very, very difficult. It is very, very difficult, but not for people who are already retired. Okay, so to qualify for the loan, you need to have the net worth. And then after you purchase the deal, you must still have 10% of cash left over. So let me use an example. Let's say you buy a deal and you take out a loan for 10 million, right? That means all the sponsors or active partners, all their net worth together must be at least 10 million. After you have finished buying the deal, you must still have $1 million in cash left over. Okay, you must have 10% of the loan value in cash after the deal is done. That's how Fannie Mae feels safe. He knows that you guys have enough money to cover the deal, and you guys have enough cash to put it into the deal to save it in case it is running low on money. So not easy to qualify, right? They also require that in order for you to have get a Fannie Mae loan, you must have Fannie Mae experience. You must have experience operating similar properties. So it's a pretty high bar. Yeah. But Fannie Mae, but for getting a loan on these large multifamilies, they care about your experience more than they care about anything else. They care about your financial position. They care about your experience in running properties. They don't really care about your credit score. Credit scores are for single family, small deals, when you're talking about 20, $30 million, they want to look at your financial well-being and experience in running this size of property. Okay. Helen has a question. The most you can lose is your investment, right? That's right. Okay, so first of all, your name is not on the loan, so the lender will never go after you. Okay. Second of all, the kind of loans that we get are called non-recourse, meaning if the value of the property falls below the loan, the bank cannot come after us for the difference. Okay, so let's say we buy a $10 million property. After COVID, after whatever, something terrible happens, it's only worth $5 million now. Fannie Mae cannot go after the sponsors and tell them to pay the $5 million difference. Okay. Yeah, and we also structure it as an LLC, so if there's a lawsuit, it will never reach the passive investors. Okay. We also take out a $10 million umbrella policy, insurance policy on the deals. So we're, there's always risk in everything we do, but we do everything we can to mitigate each and every one of risk, so that even if we get sued, even whatever, the limited investors will not be impacted. Okay. For married couple, the net worth is combined net worth. Yes. Yeah. So when qualifying, if you ever want to acquire deals, then the net worth that you qualify for the loan with is for the married couple, the combined. Yeah. There's actually a lot of very interesting topics here. But probably not for this meeting, but I mean, I'm happy to share how to acquire properties. What is the process? What are the things to watch out for? How do you find deals to invest in? All that kind of stuff. So, it's a lot of very interesting things. Cool. All right. Does anybody have any other questions? Okay, so let me do this. I'll set up another meetup where we can talk about how these syndications operate in general. I think it's still a pretty new concept to many people, so I'll do another meetup on that. Okay, cool. Well, thank you, Brian. Thank you for taking the time and share this great information with us.
Sure. I enjoyed it.
Yeah, I will send out the slides for today's presentation, as well as Mr. Eastman's slides, and on those slides will be how you can reach him, and set up for a session like that. And if you have any questions, just feel free to chat with me. I'll be more than happy to answer.
Very good. Well, thanks again, Tony, and thanks everybody for joining us. Have a great evening.
Yeah, have a great evening, everybody.
Thanks, Brian. Thanks, Tony.
Sure.
Thank you, guys.
Yeah.
Thank you.
Thanks, Tony.
Sure. Good seeing you guys after so long. I need some social activity.